Bitcoin. The very mention of this digital currency can spark a myriad of emotions and reactions. The very word evokes a sense of excitement, a rush of adrenaline, and for many, the thrill of potential riches. But it also brings with it trepidation, anxiety, and for some, a deep sense of confusion. The world of Bitcoin is as complex as it is exhilarating. It's been called a bubble, a scam, and even a Ponzi scheme by its harshest critics. Headlines have screamed warnings of impending doom, yet others hail it as the future of money, a revolutionary force that could reshape the financial landscape as we know it. One thing is for sure, Bitcoin is never boring. Its journey has been marked by dramatic price swings, capturing the attention of investors and the media alike. Its price has been on a roller coaster ride since its inception, experiencing dizzying highs and gut-wrenching lows. From its humble beginnings to its meteoric rise, Bitcoin's story is one of volatility and unpredictability. The peaks and troughs of Bitcoin's price have left many investors exhilarated and others devastated. It's a market that can make fortunes overnight and wipe them out just as quickly. But beyond the volatility lies a technology with the potential to revolutionize the way we think about and use money. Bitcoin is built on a foundation of blockchain technology, a decentralized ledger that promises transparency and security. Bitcoin is a decentralized digital currency, meaning it operates without a central bank or administrator. This decentralization is one of its core strengths, offering a level of autonomy and freedom that traditional currencies cannot match. Transactions are recorded on a public, transparent ledger called the blockchain, secured by a global network of computers. This ensures that every transaction is verifiable and immutable, reducing the risk of fraud. The blockchain is a revolutionary technology in its own right, with applications far beyond just digital currency. It has the potential to transform industries from finance to supply chain management, offering unprecedented levels of transparency and efficiency. Secured by a global network of computers, the blockchain is virtually tamper-proof, making it one of the most secure systems ever devised. This security is a key factor in Bitcoin's appeal. This revolutionary technology has captured the imagination of investors, entrepreneurs, and everyday people alike. From tech enthusiasts to financial experts, Bitcoin has sparked a global conversation about the future of money. So, what's next for Bitcoin? The future is uncertain, but the potential is enormous. As more people and institutions adopt Bitcoin, its influence continues to grow. Many experts believe we are on the cusp of another major bull run, with 2025 shaping up to be a pivotal year. The factors driving this optimism are varied and complex. With advancements in technology, increasing institutional interest, and a growing acceptance of digital currencies, the stage is set for Bitcoin to reach new heights. The year 2025 could be a turning point, marking a new era in the world of cryptocurrency. Let's delve into the factors driving this optimism and explore what the future might hold for the world's most famous cryptocurrency. From regulatory developments to technological innovations, the landscape of Bitcoin is ever evolving. As we look ahead, one thing is clear: Bitcoin is here to stay. Its journey may be unpredictable, but its impact on the financial world is undeniable. Whether you're a seasoned investor or a curious newcomer, the story of Bitcoin is one worth following. Bitcoin's history has been marked by distinct cycles, often referred to as four-year cycles or halving cycles. These cycles are a fundamental aspect of Bitcoin's design and have profound implications for its price and market behavior. These cycles are intrinsically linked to a fundamental event programmed into Bitcoin's code, the halving. The halving event is a predetermined reduction in the reward that miners receive for adding new blocks to the blockchain. Every 210,000 blocks mined, which happens roughly every 4 years, the reward for mining new Bitcoin is cut in half. This reduction in block rewards is a key feature designed to control the supply of Bitcoin over time. This event has significant implications for Bitcoin's price and overall market dynamics. By reducing the rate at which new Bitcoin is introduced into the market, the halving event creates a scarcity effect. Why does the halving matter? The answer lies in the basic economic principle of supply and demand. When the supply of a commodity is reduced while demand remains constant or increases, the price of that commodity tends to rise. It all boils down to supply and demand. The halving event reduces the supply of new Bitcoin entering the market, which can lead to increased competition among buyers and, consequently, higher prices. By reducing the rate at which new Bitcoin is created, the halving constricts supply. This controlled reduction in supply is a deliberate feature of Bitcoin's design, intended to mimic the scarcity of precious metals like gold. If demand remains constant or increases, this supply squeeze can exert upward pressure on the price. Historically, this has often led to significant price increases following each halving event. Historically, each halving event has been followed by a period of significant price appreciation, often referred to as a bull run. These bull runs have attracted a lot of attention from investors and speculators, further driving up the price. Past performance is not necessarily indicative of future results, but understanding these historical cycles can provide valuable context for analyzing Bitcoin's future trajectory. By studying past halving events and their impact on the market, investors can make more informed decisions about their Bitcoin investments. It's also important to consider other factors that can influence Bitcoin's price, such as regulatory changes, technological advancements, and macroeconomic trends. While the halving is a significant event, it is just one piece of the puzzle. The halving event also has implications for Bitcoin miners. As the reward for mining new blocks is reduced, miners must become more efficient and find ways to reduce their operational costs to remain profitable. This often leads to innovation in mining technology and practices, as miners seek to maintain their profitability in the face of reduced rewards. The competition among miners can drive advancements in hardware and energy efficiency. Additionally, the halving event can have global implications. As Bitcoin's supply becomes more constrained, its role as a store of value and medium of exchange can be affected, influencing how it is used and perceived around the world. In conclusion, Bitcoin's 4-year cycles, driven by the halving event, are a fundamental aspect of its design. These cycles have historically had a significant impact on Bitcoin's price and market dynamics, and understanding them is crucial for anyone interested in the world of cryptocurrency. As we look to the future, the lessons learned from past halving events can provide valuable insights. While the future is always uncertain, the patterns observed in Bitcoin's history offer a framework for anticipating potential market movements and making informed investment decisions. Whether you're a seasoned investor or new to the world of cryptocurrency, understanding Bitcoin's 4-year cycles can help you navigate the complexities of this dynamic market. Stay informed, stay vigilant, and always be prepared for the unexpected. Remember when Bitcoin was seen as the Wild West of finance, shunned by institutional investors? It was a time when the very mention of Bitcoin would elicit skepticism and doubt from the financial elite. The cryptocurrency was often associated with high volatility, regulatory uncertainty, and a lack of intrinsic value. Many traditional investors viewed it as a speculative asset, akin to gambling rather than a serious investment. Those days are long gone. The narrative around Bitcoin has undergone a dramatic transformation. What was once dismissed as a fringe technology is now being embraced by some of the most influential players in the financial world. This shift didn't happen overnight. It was the result of years of development, increasing adoption, and a growing recognition of Bitcoin's potential. Over the past few years, we've witnessed a seismic shift in sentiment as Wall Street has warmed up to Bitcoin. Financial analysts who once scoffed at the idea of digital currency are now discussing its merits on major news networks. Investment firms are dedicating resources to understanding and integrating Bitcoin into their strategies. This change in attitude is not just a trend, it's a fundamental shift in how the financial industry views digital assets. Major financial institutions, once skeptical, are now adding Bitcoin to their portfolios. Companies like Fidelity, BlackRock, and Goldman Sachs have started to offer Bitcoin-related products and services to their clients. This institutional adoption is a strong signal of Bitcoin's growing legitimacy and acceptance in the mainstream financial world. It's no longer just tech enthusiasts and retail investors who are interested in Bitcoin. It's the giants of Wall Street. This institutional adoption is driven by several factors. One of the primary reasons is the search for alternative assets in a low-yield environment. With traditional assets like bonds offering minimal returns, investors are looking for new opportunities to generate alpha. Bitcoin, with its unique properties and historical performance, has emerged as a compelling option. Additionally, the increasing regulatory clarity around Bitcoin has made it more accessible and less risky for institutional investors. First, Bitcoin is increasingly viewed as a legitimate asset class, often referred to as digital gold. This comparison to gold is not just a marketing gimmick, it reflects Bitcoin's potential to serve as a store of value. Like gold, Bitcoin is scarce, with a fixed supply of 21 million coins. This scarcity, combined with its decentralized nature, makes it an attractive hedge against inflation and currency devaluation. Its limited supply, decentralized nature, and potential as a hedge against inflation have made it an attractive alternative or addition to traditional assets. Investors are increasingly viewing Bitcoin as a way to diversify their portfolios and protect against economic uncertainties. The recent economic turmoil and unprecedented monetary policies have only heightened interest in Bitcoin as a safe haven asset. Second, the infrastructure for institutional investors has matured significantly with the emergence of regulated custody solutions and trading platforms. Companies like Coinbase, Bakkt, and Fidelity Digital Assets have developed robust systems to securely store and trade Bitcoin. These advancements have addressed many of the concerns that institutional investors had about the security and reliability of Bitcoin investments. As more institutional players enter the market, bringing with them their vast resources and influence, we can expect to see a surge in demand for Bitcoin, potentially fueling the next bull run. The entry of these large players not only adds liquidity to the market, but also brings a level of credibility and stability that was previously lacking. This growing institutional interest is likely to have a profound impact on the future of Bitcoin and the broader cryptocurrency market. Section 4. Regulation, friend or foe? The quest for clarity in the crypto Wild West. Regulation has long been a double-edged sword for the cryptocurrency industry. On the one hand, clear and balanced regulations are essential for fostering trust and attracting mainstream adoption. On the other hand, overly burdensome or restrictive regulations could stifle innovation and hinder the growth of the industry. The good news is that regulators around the world are beginning to understand the importance of creating a regulatory framework that fosters innovation while mitigating risks. While there are still challenges to overcome, the trend seems to be moving towards greater clarity and certainty in the regulatory landscape. This increased regulatory clarity is crucial for institutional investors who require a predictable and transparent legal environment. Section 5. Bitcoin Beyond Payments. Unveiling new use cases. Bitcoin was initially conceived as a peer-to-peer electronic cash system. While it continues to serve this purpose, its potential applications have expanded far beyond payments. Today, Bitcoin is being explored as a tool for financial inclusion, cross-border remittances, supply chain management, and even as a store of value in countries experiencing hyperinflation. This expanding range of use cases is driving demand for Bitcoin from a wider range of individuals and organizations. As the Bitcoin ecosystem continues to evolve and mature, we can expect to see even more innovative applications emerge, further solidifying its value proposition.